along here as well. Joining us now to give more of a take on today's activity, we've got Thomas Hayes, who is the chairman of Great Hill Capital. Tommy, always a pleasure to speak with you. Let's get your breakdown after a down week on Wall Street. Stocks across the board, they bounced back today. What was the catalyst for today's turnaround, you think?
Yeah, well, great to be with you, Brad, as always. If you remember 2 weeks ago, we were on talking about a bifurcated market where you had pockets of tech that seemed overvalued and then laggard cyclicals that were undervalued. And we pointed out Apple at that point in time because it was trading at 39 times current year earnings, or a 61% premium to its highest multiple of the past decade, which was 24 times. And sure enough, in the last 2 weeks, it's come down about 18%. So I think we're still in this bifurcated market where money's going to slowly come out of some of these overvalued stocks and start to move into better valued stocks. And this is a function of the reopening trade. And the real trigger catalyst that we've been waiting for on this reopening trade, a slight move of relative outperformance into cyclicals and value, is the vaccine. And we got great news on the vaccine over the weekend. The AstraZeneca and Oxford study has been renewed in phase 3. It was paused for a little bit. And then this morning, you had the CEO of Pfizer on saying that he believed vaccines would be delivered before the end of the year. And that's why you're seeing, banks are up today, et cetera. And a number of those value stocks are starting to come in. And then you also had Merger Monday for tech, and tech got bit as well. So as you opened with, Brad, pretty much everything was up today. But as we look at the vaccine now, we've got 25 vaccines in phase 1, 14 vaccines in phase 2, 9 vaccines in phase 3, and 3 have actually limited approval and 0 have full approval. We need a full approval vaccine, which hopefully will be in the next couple of months.
Okay, and so I've got kind of this checklist that I go down every day of all of the big things that we kind of need to keep an eye on. The vaccine certainly is at the top of that list, but additionally with that, it still does come with this looming U.S.-China trade talk that does need to be reinitiated on many different points and many different negotiating kind of elements there. And as you're continuing to watch perhaps one of the biggest business stories of the day in Oracle and TikTok, and Oracle being, let me make sure that I have this language correctly, yes, the trusted technology provider, what does that mean to this broader thread of the U.S. and China trade talks to you?
Well, I think the number one thing that I've been paying a lot of attention to, Brad, is just how quick China has recovered. If you remember, their peak cases were in mid-February. Our peak cases in our epicenter were in mid-April. And just last month, their domestic air travel was at 86% of pre-pandemic levels. Analysts are expecting 100%. And we're kind of tracking in that kind of trajectory. Even without a vaccine, we hit about last week about 936,000 in one day, which was about 40% of our pre-pandemic levels. So I think you're going to see a lot of pre-campaign rhetoric, to answer your question, between the U.S. and China. It's going to get more pronounced. But I think after the election, whoever's in, I think things are going to get better. The number one thing to our relationship has been the phase 1 trade deal follow through. And because the Chinese had this drought and they had problem with transport with ag, they're actually up to speed on the promised agricultural purchases. They're herd of pigs culled, so they need pork from us. They need agricultural products from us. So those purchases have been ahead of schedule. They need to pick up the pace on the energy as their demand comes back with air travel. So long as those purchases continue, Brad, I think that it's going to be more rhetoric than substance. I think the substance is that it's moving along generally okay for the time being between the U.S. and China.
Okay, and so I don't think that you and I have spoken since when we heard from the Fed recently, and the Fed kind of signaled that, look, interest rates right now, they're going to essentially stay pretty much static at this point in time, and there's going to be no essential movement that takes place. What's your reaction to the Fed and their recent commentary about the economic scene, how they're going to continue to support that, and what does that signal for growth, bringing jobs back, which of course the Fed touts as one of its core responsibilities and continues to talk about?
Yeah, well, what they've said is they're going to let the economy run hot. So symmetric inflation, they'll let inflation run above 2%, their target, for as long as it takes to get to full employment, and specifically for the amount of time that it was under 2%. And this is in line with my economically sensitive stocks starting to do well. If you look at the spread, the yield curve between the 2-year yield and the 10-year yield, it's actually been widening, which is good for banks. And we think that this is a sector that's tremendously undervalued due to what is called CECL. It was an accounting change that went into place in Q2 of 2020 that basically the big four banks only earned $5 billion pre-tax versus $28 billion the same period last year. But a lot of that was attributable to having to take 100% of loan reserves at the time of origination. So when you compare apples to apples, if you take CECL out, which just came in Q2, which is when everyone went negative on banks, we would have earned $28 billion versus $34 billion. And considering we shut down the world for 2 months to only have a $6 billion loss is much better than how it appeared that we dropped from 34 billion down to 5 billion, which simply isn't the case. That's number one. Number two, as those reserves to prove to be over conservative because of the accounting change, those reserves are going to come back on in coming quarters and years as income. So you have a number of big banks trading at discounts to book. So while everyone has been chasing the overvalued pockets, which have started to come in, I think the pain trade moving forward, and we were on a few months ago talking about the pain trade for the general market being up because everyone was looking for a retest of the lows. And when everyone's looking for the same thing, it doesn't happen. I think the pain trade in coming weeks, after this technical bounce in tech in particular, I think there's a little more to work out on tech. And I think some of these laggard sectors are going to start to get the benefit of that and start to get flows as we get closer and closer to a vaccine. So we're pretty optimistic on banks building positions there, while we think tech has a little time to work itself out before it finds more solid footing.
Well, Tom, from your perspective, what are investors pricing in right now from the kind of thinking around stimulus and whether or not we will get a deal before the election?
Yeah, I think, we had over $10 trillion of stimulus aid and liquidity authorized since March, much of which we haven't used. I think if we get a deal, it would be really beneficial for the people most in need, with an additional stimulus check, possibly enhanced unemployment extending past the executive order. I think that's critical. As far as the general stock market and general economy, we've had 25% money supply growth since March. So generally about a quarter of that will translate into GDP, which means we could grow at 6.5% GDP in 2021, and we haven't seen that in decades. So, at this stage, I think the market's pretty skeptical about any stimulus package getting done. Maybe they'll do something because they have to go home and face their constituents before the election. But on balance, I don't think it would be a tragedy if from a stock market standpoint. I think it would be a tragedy from a human standpoint if they didn't get something done for those most in need. But I think as far as the stock market and the S&P 500, it would push ahead.
An investor with a humane perspective and level head. Tom, always a pleasure to get your insights here on our show. Tom Hayes, who is the chairman of Great Hill Capital, joining us here on the day's activity. All right, guys, and come on.